Good evening, ladies and gentlemen. Once again, a warm welcome to all of you at ASK Investment Managers Quarterly Call. I am Gaurav Chakravarti and I'll moderate today's call for you. To take a lead from our Honorable Prime Minister, Mr. Narendra Modi, India's economy shines as a beacon of hope in these challenging times. With robust growth and resilient spirit, the future looks promising, and we are indeed heading towards becoming the third largest economy globally. Driven by a better than expected performance in the last quarter of financial year 24 and above 7% growth projection in the year FY24, indeed our growth is tilted northwards. This reflects the resilience of the economy to sustain its growth path amidst ongoing geopolitical headwinds, and that forms the part of our discussion today. And for that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK Investment Managers Limited, with us to assess the condition prevailing in the global and domestic market. And he shall take us through the highlights of our ASK Growth portfolio as well. ASK Growth portfolio is one of the industry's first PMS investment approach launched way back in 2001 January and now has a track record of more than 23 years. And in this period, it has compounded at a rate of 19%. Sandip comes with a 2 decade of work ex with more than 15 plus years in equity market. He has been instrumental in managing our growth portfolio since the time he has joined us from SBI Life, where he was the head of investment research leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, we have scheduled an hour for this webinar where I would request Sandeep to cover broader trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of the ASK growth strategy. Insight on what happened in this financial year so far, where we stand now, and how we see things going forward. This will be followed by question and answers. So I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Sandeep.
Thank you so much, Gaurav. Welcome everyone to this webinar. Thank you so much for joining in. Gaurav, I would be sharing my screen and please do let me know once it's visible.
It's visible, Sandeep.
Yeah, thank you. Are the slides changing?
Not yet. Try once more. Yeah, it's changing now.
Okay, thank you so much. So we'll first start off with the broader market outlook and then we will move to the growth portfolio specifically. So if we look at the global environment, inflation is falling and trending down across regions, whether it be US, UK, EU. The dark blue bars in this graph are the inflation numbers about a year ago, and the lighter blue bars are the inflation numbers, the recent prints that are available. Across regions, we can see that inflation has come off sharply. What has this led to? This has essentially led to an expectation of interest rates peaking out. The central banks globally are no longer raising interest rates for the last many months, and actually they are looking to, there is an expectation that rates would actually be cut. If we look at this slide, which essentially highlights what the market expectation is regarding the US Fed fund rate, it becomes very clear. A US Fed essentially sets the global cost of capital. The Fed funds rate currently is in the region of 5.25 to 5.5. The expectation broadly is that even in the minimum case, I mean, let's assuming that, Fed does not cut rates aggressively, even in that scenario, Fed funds rate is expected to be 4.5% by the end of this calendar year, basically highlighting the expectation of the market that there will at least be a 75 basis point kind of a cut through this calendar year. The way to read this chart is that the boxes highlight the probabilities of various Fed funds rates, and the colored boxes are where the majority of the opinion lies. So let's say there is an expectation by 37% of the people that the Fed funds rate would be 3.75 by the end of this year. Obviously, a cut in interest rates is going to be positive for equities, because equities is a long duration asset class, and especially it is going to be positive for styles that invest more towards higher growth companies. Are there any risks that we are seeing to the inflation? Obviously, there are geopolitical risks that continue. So one of the risks that has manifested itself in terms of having a direct impact has been the rise in freight costs. Obviously, supply chains do get impacted whenever there is any conflict globally, whether it be the Russia-Ukraine conflict or the one that we've seen in the Middle East. But let's say one of the direct impacts of this has been the way freight costs have actually gone up in the Red Sea. And if we see this increase over here, it clearly shows that in a very short period of time, freight rates have gone up. It does three things. A, it impacts the freight costs of all exporters as well as imports that we get. Secondly, it increases timelines, so uncertainties go up, and hence companies would like to actually order more and keep inventory. So thirdly, this kind of impacts working capital as well. So that is a negative fallout and a risk to global inflation as well, if these conflicts do not remain localized, and if they involve more countries, or if they expand. Obviously, if they continue for a longer period of time, that will also have a negative impact on global growth and our exports as well. Now, looking at how the domestic situation is shaping up, this is a chart which highlights the CPI in India. If we look at the light blue line over here, that is the overall CPI. The dark blue line is the food inflation, and the yellow line is the core CPI. So what has put an upward pressure on CPI in India has been more the food inflation, while the good news is that the core CPI is actually trending down. Even in September 23, when CPI had spiked, it was led by food inflation, while core CPI had not gone up that much. This specifically points out to the fact that there is a very good chance of inflation remaining under control unless food inflation goes out of hand, which can be a situation if monsoons this year are not good. Otherwise, the inflation situation in India is expected to be within the RBI targeted range of 4 to 6%. There is an expectation that if US Fed cuts interest rates, then the RBI might also follow suit, and the RBI might not preempt the US Fed. So globally, interest rates could come down this year, and that could be a situation in India as well. If we look at the overall market backdrop, what we have seen is that the capital investment side of the economy continues to do well. That is why, against a GDP growth of around 7.3%, the gross fixed capital formation is likely to grow at a much higher rate of around 10.3%. This is also evidenced by the growth in materials that we are seeing, whether it be cement, steel, which are expected to grow at 9 to 10% in this financial year. The interim budget had also pointed pointed out to continued capex intensity in the economy. So in FY24, the total central government capital expenditure is expected to be around 9.5 lakh crores, and this number is likely to be around 11 lakh crores for FY25, which is a very healthy growth of around 17% on a year-on-year basis. If we look at the consumption side of the economy, the consumption side of the economy, the news has not been that great. Private final consumption expenditure is actually likely to grow more like 4.5%. We have seen volume growth on the discretionary side to be a bit weak, which basically points out to a weaker demand growth that has been there. Now, the third piece of the economy, if we look at on the export side, exports has also remained subdued. This has been due to weaker global growth, and also there has been inventory destocking cycle globally, which has impacted the exports of our goods. Overall, the picture has been that investments continues to do well. Exports is impacted by global growth, while consumption has been weak as of now. If we look at the Q3 results of the companies of corporate India, the results season just concluded. Whatever we saw on the macro backdrop, this kind of flows through in the company's results as well. So capex, capital expenditure led businesses did very well in Q3, while domestic consumption and exports were weaker. IT sector was expected to be mute, and that was the case. Pharma companies reported good volume growth. Their margins were also aided by better raw material prices. On the auto side, we saw relatively good numbers from two-wheelers and passenger vehicles, while tractors and commercial vehicles did not fare that well. If we look at consumer discretionary, the volume growth that we saw in the festive seasons did not follow through. This has been due to poor agri income as well as the effects of inflation. On the financial side, we saw higher cost of funds impacting the margins of lending businesses, while lower provisions on a YOY basis still aided profits. The non-lending businesses in the BFSI sector fared better than the lending businesses. So this was the overall highlights of the just concluded results season in this quarter. If we look at the trends for the BSE 500, in this slide, if you look at the trends every quarter, what we see is that sales growth has been somewhere in the low to mid single digit kind of a range for the last 3 quarters. And the heavy lifting for earnings have actually been done by margins. That is why operating profit growth has been higher than sales growth. And obviously, operating leverage has benefited, which has led to a better earnings growth as well. This has been for the case for the last 3 quarters now, which is highlighted in the top table of this slide. If you look at the bottom table, this shows how margins have changed on a YOY basis and versus pre-COVID levels. So if you look at it on a YOY basis, margins have gone up by around 1.5%, while now on a pre-COVID basis, they are flat. So basically, if we look at Q3 FY20, assuming that COVID hit in Q4 or FY20, then, margins have reached those levels. Now, going forward, earnings growth would require top-line growth to come through. So it is important that there is demand revival in the consumer sector. It is important that there is pickup in global demand growth. And obviously, while government is doing the heavy lifting in terms of investments and likely to continue to do so for next year as well, but at some point of time, private capex also needs to come back. because sales growth is now important as far as earnings growth trajectory is concerned. Overall, for the market, these are the earnings for Nifty. Nifty is expected to post a high teen kind of an earnings growth for the next couple of years. So between FY23 to FY25, Nifty earnings are expected to grow between 17 to 19% on a CAGR basis. Now coming to our portfolio specifically, this is the market cap classification of the portfolio. So broadly speaking, 2/3 of our portfolio continues to comprise of large caps, around 62.5%, while around 1/4 is in mid caps and around 10% or so is in small caps. We do believe that there is larger valuation comfort and potential today in large caps versus mid caps and small caps. That is in general. However, our mid caps and small caps are likely to continue to do well because of strong earnings growth and the margin of safety at which we have bought them. If we look at the sectoral breakup of our portfolio, we have made a number of changes because of which now around 1/3 of the portfolio, actually 36% of the portfolio, comprises of sectors that are aligned to infrastructure. These could be material suppliers, these could be asset owners, these could be financiers. So there are a number of businesses in the portfolio which are now aligned to this theme. And as we have seen that this sector continues to receive a lot of government attention, there is a lot of policy focus, and there is also construction activity in the real estate sector, which will benefit a number of companies that we've added to the portfolio. On the BFSI side, this comprises around 30% of the portfolio. Over here, also we have added infrastructure financiers, which should help performance going forward. And there is a lot of latent value in some of the businesses that we own here. The consumption side of the economy represents around 15% of the portfolio today. This part of the economy, this part of the portfolio has done well for us with names like Varun Beverages, Titan Industries, Patanjali, etc. Telecom is 6% of the portfolio. This is essentially represented by the Bharti stock, and that has also aided performance and given good returns during the last quarter in this financial year as well. Chemicals has been one sector which has dragged our performance. Chemicals is getting impacted by inventory destocking cycle that is happening in China. We believe that a number of these businesses continue to have good long-term growth prospects. Inquiries in this sector continue to be good. Businesses have invested a lot. And while there is a down cycle, which could continue to impact for a quarter or more maybe, but we do see a lot of potential in this space going forward. We have seen all large major economies having large chemical sectors, and we believe that manufacturing in India will pick up in a major way, and chemicals is going to be one of the core industries. For us, oil and gas, there was one name which we've exited, Gujarat Gas, which was not doing well. Even on the consumption side, because of pressure on discretionary consumption, some names which were not doing well for us for a period of time, we've exited those names, and which we will discuss in this slide in terms of the actions that we've taken. What we've done is that we have increased our presence in the manufacturing, infrastructure, defense, auto side of the economy, while we've exited names on the IT side, on the chemical side, as well as on the consumption side, which had been drags on our performance. The businesses that we owned are high quality businesses. So the businesses per se are very good, but due to some of the other macro reason or maybe some company specific reasons in some instances, the stock performance was not coming through. And there is greater activity potential and longer term visibility in some of these sectors, which we have significantly added, because of which now around 1/3 plus of our portfolio represents sectors aligned to the infrastructure, defense, and capital expenditure themes. If we look at the performance of our portfolio companies in the gone by quarter recently, operating profits have grown at around 13%, which has been higher than the market. If we look at the sales growth, that has also been better. Our expectation for the full year is also better than what the market is likely to deliver, and similar is the expectation going forward as well, because the portfolio does comprise of businesses which have higher growth potential and long-term visibility for growth as well. And it is not just that the businesses are expected to deliver good profits going forward. Historically, also, if we look at it, this is a list of our portfolio companies, and this is their earnings growth over the last 5 years. If we look at over the last 5 years also, the earnings delivery has been better than that of the market. This is just the last slide wherein we present the key portfolio psychographics, assuming that the entire portfolio was one single stock. If we look at the earnings growth over the next couple of years is expected to be in the 22% plus kind of a range. If we look at the return on capital, that is expected to be in the 32 to 33% kind of a range over the next 2 years. The balance sheet position of the portfolio as a whole continues to be good, with debt to equity ratio being close to 0. This in a way highlights the quality of the portfolio companies that we own. All of the businesses, most of the businesses that we own are high return on capital and high free cash flow generating businesses. And the long-term growth trajectory of these businesses is also expected to continue to remain solid. So I will stop here, and Gaurav, now we can open the floor for questions, please.
Thank you, Sandip, for a detailed brief on the portfolio and sectors as a lot. I request all the participants to type in your questions on the chat box, and we shall try to curate all of them. In the meantime, Sandip, we have already got a few questions from our investors and partners in advance. I request you to share your thoughts on the same. The first question would be, how are you going to position the portfolio and its outlook for FY24 / sector of the portfolio do you think have a higher possibility of alpha generation?
Sure. So thanks, Gaurav, for the question. We have done a number of changes in the portfolio over the course of the last 3 to 6 months. As we discussed in the slide pack, we have significantly increased exposure towards businesses that are aligned, associated, or direct beneficiaries of the infrastructure, capital expenditure, and defense themes in the country. These sectors have been witnessing substantial policy changes, massive project execution, and large fund investments by the government for now. Obviously, at some point of time, we do expect in the next year that the private side of the capital expenditure is also going to pick up. We do see good long-term visibility of spending in these sectors because of the government's clear intent that infrastructure really needs to be beefed up. If we look at any economy that needs to have a significant proportion of manufacturing, which is, let's say, the government's long-term aim to take manufacturing as a sector from 17% contribution of GDP to around 25% of contribution to GDP, then obviously we require a lot of expenditure on the infrastructure side um, for managing the supply chain, goods movement, good connectivity, whether it be ports, road, etc. Anyways, there is very high focus on air travel as well. So all of this combined, we believe, will sustain investments in this space. Manufacturing will obviously require good and stable power supply as well, and energy transition is also going to be a big theme. So these are the spaces that we've invested in over the last 3 to 6 months. This now comprises around 1/3 of our portfolio. This has also led us to invest in a lot of a lot of PSUs, because the defense sector is dominated by the PSU space. So we have added names like Hindustan Aeronautics, Bharat Electronics over the last 3 to 6 months, and luckily they've done well for us. On the energy side also, we've added Indian Oil Corporation. And on the asset side, on the infrastructure asset ownership side, we've added names like JSW Infrastructure, KEI Industries, etc. And we continue to evaluate and analyze this space very closely. If there are more meaningful opportunities that come through, we will drive more investments into this area.
Thanks, Sandeep. Now I'll club 2-3 questions together. We already got some questions on the chat box as well. Now, if I look into, in respect to the stocks which you have said, in the last 6-7 odd months, we have added bountiful of stocks in the portfolio. Like if I combine two questions, like it has, you said 36% on the infrastructure, 29% on the BFSI. So if I put together PSU, industrial and engineering basket, what are we going to see from here on? Like, as you say, is the latent value still visible enough into the spaces to gain, more alpha from here on?
Sure. No, that's a very valid question. We believe that there is definitely a lot of money still to be made. So we were, let's say, not the earliest ones to catch this space, but having got onto them maybe slightly late versus the others, from then onwards, it's also, these spaces and these stocks that we've selected have done well for us. I would like to believe that it might not be that all the names in the sector will do well. It will be difficult to comment on how the entire sector plays out in terms of stocks. But the names that we've selected, obviously we've selected after a lot of deep dive and detailed analysis. Luckily, they've done well for us already, but we do believe that they have a long runway for growth. The way we've gone about selecting them is maintaining our peg of quality, focusing on the unique properties and characteristics that these businesses have, and the fact that and the expectation that they have certain leadership attributes which will help them to continue to do well over a longer time horizon. So we are not, when we are investing in these names, we are not necessarily looking at only a shorter time horizon. We've taken our usual strategy of looking at the long term, and hence we focused on the balance sheet, the quality of earnings, the sustainability of earnings, the predictability of earnings. So that has also been a very important contributor to our decision making. If we look at only the quantum of earnings, then maybe some of the stocks in the space could fizzle out. But we believe that the names that we've selected should continue to do well.
Great, Sandeep. Now you spoke something about very important aspect of interest rate falling. That's the question everybody is revolving around right now, whether the interest rate will fall now or later. So on that particular aspect, my question would be, as the interest rate cuts in the economy or it falls, there is downward pressure on bond yields along with cost of equity. How the same is going to impact our set of companies? Generally, rate cuts favors the high growth rate / high PE companies.
Sure. So that interest rates have peaked out is generally accepted, and one can go by that scenario for sure. As to when the rates will actually get cut, it's anyone's guess. That's a difficult one to take a bet on. Initially, there were expectations that a cut could happen in March itself. Then I think it got pushed out a bit. There are some expectations that the US Fed could cut actually in the second quarter, which is the June quarter. Then there is a section of the market that believes it could be cut more in the third quarter. The cut in interest rates could potentially be driven by two scenarios. One is the way the inflation behaves. While the latest print in the US was slightly higher than what was expected to be, but the general trend is still downward. And if inflation continues to go in the downward trajectory, then obviously the Fed gets a greater comfort. The other way to look at it is what kind of an impact the high interest rate scenario is having on growth per se. So far, the growth numbers in the US have been good, but if they start to falter, or anecdotally there is evidence that growth is getting impacted, then that could force the Fed's hand sooner than later. A cut in interest rates, whenever it happens, the markets would like to price that in before the actual cuts come through. Generally speaking, a fall in interest rates is good for equities as an asset class. It aids sentiments from a risk on perspective. What it also does is it reduces the discounting rate that one uses in cash flow models to discount the cash flows of a business to present value. So to that extent, fair valuations for equities generally move up when interest rates go down. Obviously, they go down when interest rates go up. For growth equities, because a larger part of the valuation comes from later years and discounting has a greater impact in the later years because a larger part of the value resides in the later years due to higher growth. It is like a longer duration bond, and a longer duration bond rises more when interest rate falls than a shorter duration bond. So that is the way to think about growth equities. So generally speaking, growth equities should do better than other kind of equities in a falling interest rate environment. So yes, it should have a favorable impact as and when it happens, or as and when the market starts to price that in.
Great. In the meantime, I request all the participants to type in your questions. We shall try answer them. You spoke about when interest rate, obviously the question comes in the negative threats to it, right? So you can see you already spoken about a Red Sea crisis, which can pose a long-term threat to the commodity prices. And it can actually, take further leading to extend tight monetary conditions globally. Don't you think, it will impact or help not to take decision by Fed a little longer on this particular aspect? And if yes, by what timeline you believe they should settle in?
So Gaurav, it is, yes, there is a risk that if the conflicts that we are seeing either in Europe or in the Middle East, so far they've been relatively localized in some sense. If they spread out and involve a larger number of countries, the risks to global growth, the risks to commodity prices, and the risks to sentiment because of uncertainty going up definitely does increase. Also, if this goes on for a longer period of time, that is also a risk. Even if it remains localized but kind of goes on for a very long time, that also is going to be a risk. These risks, honestly speaking, it's very difficult to pinpoint in terms of what the likely outcomes of this could be and when they will exactly pan out in terms of timelines. We had not expected that freight rates, the Red Sea problem would emerge, and freight rates are going to go up substantially. So there needs to be some kind of a resolution that needs to be found out for these various crises, for us to be relatively sure that this problem is not going to recur, at least for some time to come. Till that time, the impact that it is having is that there are alternate routes that are getting explored, but obviously alternate routes for carriage and freight do involve higher costs, higher working capitals, higher transit timelines, and to that extent business uncertainty does go up. From our portfolio perspective, the majority of businesses that we own are domestic focused granular businesses. So to that extent, the direct impact on our portfolio per se is not very high. Having said this, are there direct impacts on some businesses? The answer is yes. Let's say like, chemical businesses, etc. Or even oil and gas to that extent. Is there an indirect impact? For sure, if global growth does get impacted to that extent, the Indian economy also gets impacted, and all businesses get impacted. How long will it take to resolve itself? Honestly speaking, we'll get to know only once the resolution happens. It'll be very difficult to give timelines to this because we'll not get to know the inner details ever.
Yeah, we already answered that. We are not invested into those segments which will impact much, and we have more transitory effect on our scheme of stocks at this point of time because of this escalation. Sandip, last time you spoke about certain dichotomy in the market, large, mid, or small, and I believe it's been 2.5 months from that discussion. And do you think is the shift of rally's place is inching towards large cap? Because despite the fact retail is still chasing mid and small cap at the moment as well.
So mid and small cap has done well because of two reasons. One, there was obviously, as you said, there is liquidity flowing into these names, but also because a lot of them did deliver good earnings growth as well. But we have already seen a great degree of underperformance in the general large cap basket. We would like to believe that henceforth there is larger valuation potential in large caps, given that they've already underperformed, given the quality of those businesses. Few of them could be going through macro issues, few of them could be having stock specific issues, but a lot of these businesses do seem to be pricing already their temporary or transitory problems. At the end of the day, we believe that markets will take cognizance of their earnings potential and the inherent value that is resident in them, and we should see large caps doing well. Having said this, these are general statements, Gaurav. There are pockets within the mid cap and the small cap basket wherein A, there is good earnings delivery, and B, there is good long-term growth potential. For those names, I think they can still continue to do well. Only those mid caps and small caps where the market is pricing in too much versus what is likely to come through. So maybe there isn't room for earnings disappointment as much in mid caps and small caps. And secondly, names wherein the longer term outlook is not that visible or clear as of now, while valuations have already had a run up, those names could potentially get impacted at some point.
Okay, thanks. Now, I will try to be a devil's advocate, and the question would be like we spoke in the last quarter as well, last quarterly call as well. FY23 was challenging for us. FY24 was showing a lot of promise, and in that aspect, we have done quite a lot of changes as well. And if I specifically look into the performance in the last 6 months in specific, has been very tricky for us, despite the fact we started the year on a high. What are the detractors in specific? Also, if you could cover a bit on the ASK growth AIF as well in the same continuation in respect to the performance as well.
Sure. See, what impacted us are essentially three key sectors. One is in the chemical space, we had a decent exposure. That space got impacted because of the destocking cycle we saw in China. We waited because we knew that inherently there is a lot of potential in these businesses, and they were anyways leadership businesses. But the macro uncertainty had continued too long for us, and we needed capital to deploy in other spaces. So in some of these names, we've exited and reduced exposure, like we exited SRF. So that was a drag on our performance, the chemical space, for the last 6 months or so. The other space which dragged our performance was consumers. In consumers, while there was a drag by names like Page Industries, DMart, both of these names we've exited. As we all know that these are again very solid and robust businesses, but they were going through bad macro phases. There is a consumer expenditure slowdown in the economy, as well as on the consumer discretionary side as well. We had expected that phase to be shorter than what reality turned out to be. So in spite of them being good businesses, we let go of them because we wanted to deploy capital more in the infrastructure side of the economy. But having said that, that was a drag on our portfolio. In that space, other names that we continue to hold have done well for us, whether it be a Varun Beverages, a Patanjali, or a Titan Industries. But a few names that did not do well, we let go of them. The third space, which has not done that well for us, is the BFSI space. The BFSI space in general has not been performing that well versus the overall market. Therein, what has done well for us is State Bank of India, but some of the NBFCs are not performing that well. As we have trimmed our exposure in the BFSI space to generate capital to invest elsewhere, the positions that we retain, the NBFCs or the banking names, we believe that they have a lot of latent valuation potential, which we do expect the market will take cognizance of as earnings in these businesses continue to come through. And the fact that versus the overall market, versus the sector, and versus the leadership position that these businesses enjoy, they do seem to be undervalued. So these are broadly the names, the sectors which have been drags. We've made similar kind of changes in our AIF as well. And hence now, as we discussed, around 1/3 of the portfolio is aligned, 1/3 plus of the portfolio is aligned to the infrastructure theme. And we have taken capital out from consumption, from chemicals, some from BFSI to allocate to this space. We will continue to, while bulk of our changes we think have already been made, we will continue to make more and additional changes as and when required. And infrastructure, manufacturing, etc. is a very broad theme. Within that also, we've played various sub-segments. So just to give a highlight, we have a power financier, we have an asset owner, we have a contractor, we have a structural steel tube supplier, we have cable companies. So it's a good mix. And as and when more opportunities seem to be attractive, we will continue to add. And wherever there is earnings delivery is not coming through, or we believe that valuations have become unreasonable, those stocks and sectors will continue to prune, whether it be our PMS or our AIF.
Thanks, Sandeep. This comes from the point that agility is the buzzword in today's world, and we believe in that aspect. We are doing all the right changes to be done in the portfolio. What you have demonstrated right now. So now again, the question comes again straight from a few investors as well, that how quickly we can turn around and can show alpha, because uh, if you see the 3 years, 5 years period, we have not been able to beat the benchmark. And in today's world, everything goes relatively, right? In relative basis performance, we've been not able to beat the benchmark. So how fast? Because everybody is asking about the time. So how fast we can actually create that alpha and can actually showcase that we are also relatively beating the benchmark.
Sure. So what we think is that the following things are going to hold us in good stead going forward. Again, exact timelines would be very difficult to comment upon, because there are just too many variables, not including ones which are not under our control. But the way to think about this is the requisite changes that we had to make in the portfolio for participating in areas wherein greater growth potential is there, not only in the next few years, but over a longer time horizon. We've done that, and we'll continue to do that incrementally, while showing relatively, lesser patience for, earnings misses, or let's say valuation run-ups. So that is one. Secondly, I think interest rates cooling off itself should aid our style of investing in some sense. Whenever that happens exactly, it'll be very difficult to say, because given our style of investing, a lot of we generally invest in higher growth businesses, so that should aid us going forward. Thirdly, our portfolios are relatively large cap heavy. As we discussed, around 2/3 of the portfolio is invested in large caps, broadly speaking, wherein there has been relative underperformance versus mid caps and small caps. At some point of time, that should reverse in the favor of large caps, we think, and that should also aid performance. Quality in general has underperformed and should hopefully come back at some point, which should also be good for us. So all of these things combined, we believe, will help us. If we look at the overall portfolio earnings, portfolio earnings are expected to grow at 22 to 24% broadly over the next couple of years, which is much better than that of the market. The quality of businesses that we own are very robust, solid, with long-term growth visibility. So that should also help us. All of this put together, we believe, should aid our performance.
Thanks, Sandeep. We should keep our finger crossed for the same. We have some few stock specific questions. We have added some interesting names from the small cap space like Sirma, SGS, and Ratnamani Metals. Kindly take us through about these stocks for the benefit of audience.
Sure. So Sirma SGS is in the high growth EMS space. They basically, in some sense, assemble what are called PCB boards. PCB boards are these green boards that we see in all electronics, nowadays, from fans to mobiles to laptops to ACs to air conditioners and everywhere. India imports a large amount of PCBs. Domestically, this business has now taken off, while these companies have been there for a long while. It is just that now the business is going through a relatively high growth phase. The larger companies in this segment put together, and the other names would be the peers of Sirma would be names like Keynes, Cyan, DLM, Avalon, etc. Many of them, the larger names put together are still a small fraction of the overall consumption of the country itself. And the export opportunity obviously is multiple times of that. Some of these businesses are also forward and backward integrating to cater to a larger set of opportunities. So this is a high growth space, not only in the near term, but also in the longer term. We believe that electronics manufacturing is a key component of any manufacturing sector, any large manufacturing sector. China is a very, very big player in this, obviously, like in many other industries. As we follow the concept of Atmanirbharta, import substitution, as globally supply chains diversify and more countries look at India as a sourcing hub, this business of EMS is very favorably placed within that. Sirma is if not the largest, is amongst the largest companies in this space, and it stands to benefit from this high growth over the next many years to come. So that is on Sirma. Ratnamani is a metals, tubes, pipes company. It has a very interesting business in selling stainless steel pipes and tubes to the oil and gas, refining, thermal power space. Basically, it has other business of carbon tubes, steel tubes as well. But the stainless steel tubes business is a very specialized business. This is a business which requires a lot of certifications and approvals from the client, because the pipe needs to bear high temperatures and high pressures, and it is used in critical applications in big projects, in big power plants, refineries, etc. And hence, there are only that many players that can get approvals for this specialized activity, because it takes a lot of time and credentials to build up. So it's a good way to play the entire oil and gas and industrial capex kind of theme in the country. Again, we like these businesses because of their growth potential as well as relatively good balance sheets.
Thanks, Sandip. Patanjali, the next question. Patanjali being the highest weight in the portfolio currently. Last quarter was not encouraging for Patanjali. Which segment of the product mix has not done well? And your views on the stock in the near future?
So Patanjali as a stock for us has done relatively well within the consumption space. The names that we hold, Titan, Patanjali, Varun Beverages, they've done well for us. Patanjali has two key businesses. One is their edible oil segment, and the other is their foods business. The foods business is the one. So the edibles oil business is not a very high growth business. That is more like a single digit volume growth business. And margins in that business are also not very high. They are in the low single digits. The interesting business in Patanjali is actually the foods business. The edibles oils business, by the way, is it is the second largest edible oil company in the country. So it's a substantial player. It has got plants in over 23 locations. And, it supplies pan India with very strong brands. So, that is a business which gets more impacted by commodity prices. But having said that, that's a large business in the country. When that business also aligned to that business, Patanjali is into palm oil plantations, which for them is going to give up an annuity kind of revenues and margins over the long term, which is going to be very steady. And through the plantation crops that they would be, which they are helping farmers to seed and grow plants for, they will be getting a regular assured supply of palm oil, palm seeds, which then they can use in their processing facilities. They have the second key business for them is the foods business. The foods business, is the business which is growing significantly higher than their edibles oil business. It has higher margins as well. The foods business will contribute a greater proportion of their operating profits going forward. In that business, they have products in which they are market leaders. That business has a product basket and SKUs, which is very large. There are some products in it which are very unique. Overall, Patanjali is not yet present in many parts of the country also. They are still only a fraction of the distribution in terms of distribution network versus some of their larger competitors. So as they expand their reach, we believe that they will be able to grow their volumes, especially in the foods business, while on the edibles oil side they are present relatively on a pan-India basis. So the food business has a lot of legs to grow from a distribution standpoint as well. So we continue to remain quite positive on that.
Great. Reminder to all the participants, we are nearing the end of the webinar. Request you to type your questions. Sandeep, the next question would be, last time we had a conversation and we spoke about the negative margins of the chemical sector. In fact, today also you highlighted as China in some sense dumped materials. And you could see the same for Navin Fluorine, which negatively contributed to the portfolio return. View on the stock, and is the long-term story for the sector still remain encouraging?
So, the second part of the question first, Gaurav. So the long-term story, we believe, does remain strong. As we discussed, any large economy, has had a good manufacturing sector, and within that, chemicals does play a very important role. Fluorination, which Navin Fluorine specializes in, is a very difficult chemistry because fluorine is a very volatile compound. So it does require a lot of years of experience to be able to handle that very well. So that is why in that chemistry there aren't many large players that are there, and Navin is one of the leading players in that segment. Navin obviously got impacted by the overall destocking cycle that we saw. They also got impacted by the pricing cycle in the refrigerant gases, and then they had their CEO departing. He put in his papers, and Navin had seen a very high growth phase during his tenure. So markets did take that negatively. We believe that as soon as some of the uncertainties regarding leadership and management get addressed, and obviously the promoters would be very cognizant of the same, the market gets confidence in the new leadership, I think there is inherent strong potential in the business in terms of its capabilities, its R&D skills, its technology, its infrastructure, the value proposition that it has for its clients. So we do remain positive on the name as well as the sector overall. It is just that we've trimmed our position in some of the names to make more capital available, and obviously to get accelerators in the portfolio as well.
Thanks. Sandeep, we'll take one last question for the day. Your view on Polycab, as it has been the focal point of discussion in the current times.
Right. So, that has also had a negative impact on our performance. So, there has been these stock-specific instances as well, which have been drags on the performance in recent times. They have received this income tax notice, which was there in the public domain. What we do see is that, at least in terms of overall quantum, obviously we do not know the details, and we will have to see how the verdict finally comes through. We believe that in terms of the overall context of the company, at least from whatever was available in the highlights of the notice that were there, the amounts did not seem to be very significant to have a material impact. We believe that the prospects of the company remain intact. Polycab is the leading player in the cables and wires space in the country. It has a good and growing business of exports. It is also increasingly participating in the fast-moving electrical goods opportunity in the country. The space per se is going to benefit from greater activity that we are seeing in infrastructure and real estate, not only in the near term, but also in the long term as well. So to that extent, we remain sanguine about the opportunity.
Thank you, Thank you so much, Sandeep. Would like to have your closing comments.
Yes, so as we've discussed in the call, the changes that we thought were appropriate to be made to participate in segments of the economy wherein we were relatively under-indexed. We have increased those presence. As we said, there is now 1/3 presence in the infrastructure / defense / manufacturing side of the economy, which has also led us to invest in some of the leading names in the PSU spaces, whether it will be Hindustan Aeronautics, Bharat Electronics, etc. The other part of the portfolio we believe continues to have a good valuation potential, where earnings continues to keep coming through. Overall, as a basket, the portfolio is expected to deliver higher than market earnings growth of 22 to 24%, with a very good return on capital profile and good balance sheets with businesses generating free cash flow generation. We will continue to manage the portfolio in a way to invest in higher growth businesses that are good on quality and have leadership positions in some sense in their industry.
Thank you so much, Sandeep. Thank you all the participants for attending today's call, and we shall be sharing a recording of the same. And this concludes today's call. Thank you again once. Thank you to all once again.
Thank you so much, everyone, for your time.